Time traveling your portfolio, dividends that would have made you rich. What if you could travel back in time and invest in stocks that would have made you incredibly wealthy? Imagine having the foresight to buy shares of companies that not only appreciated in value, but also provided growing dividends that compounded over time. While we don't have a time machine, we can learn from the past and use historical insights to shape a dividend-focused investment strategy for the future. This article explores some of the most lucrative dividend stocks in history and how their payouts could have transformed a modest investment into a fortune. The power of dividend growth investing. Dividend growth investing is a strategy that focuses on buying stocks with a strong track record of increasing dividends over time. The magic of this approach lies in compounding, reinvesting dividends to buy more shares, which in turn generate even more dividends. Over decades, this process can exponentially grow an investor's wealth. Some of the key advantages of dividend growth investing include passive income, steady cash flow from dividends, compounding growth, reinvested dividends generate even greater returns, reduced volatility, dividend-paying stocks tend to be more stable during market downturns, hedge against inflation, companies that consistently increase dividends can help protect purchasing power. Let's explore some historical examples of companies that made early investors incredibly wealthy through dividends. Coca-Cola, KO, a sweet investment. Coca-Cola is one of the most iconic dividend stocks of all time. If you had invested $1,000 in KO back in 1962, your investment would have been worth over $10 million today, assuming dividend reinvestment. Coca-Cola has increased its dividend every year for over 60 years, making it a dividend king. Why Coca-Cola was a winner. Consistent revenue growth, global brand dominance and pricing power. Dividend increases, long track record of raising payouts. Stock splits, multiple stock splits enhanced share accumulation. Reinvestment power, dividends reinvested over decades turned into massive gains. Investors who bought in the mid-20th century have enjoyed a steady and growing income stream while seeing significant appreciation in their initial investment. Johnson & Johnson, J&J, a prescription for wealth. Another example of a time-tested dividend stock is Johnson & Johnson, J&J. Since its IPO in the 1940s, Johnson & Johnson has been a stellar performer, particularly for long-term, dividend-focused investors. A $1,000 investment in Johnson & Johnson in 1970 would be worth millions today. Johnson & Johnson has consistently increased its dividend for over 60 years, making it a reliable income generator. Its business spans pharmaceuticals, medical devices, and consumer health products, sectors that provide stable revenue streams regardless of economic downturns. Why Johnson & Johnson was a great investment. Defensive business model, healthcare products are always in demand. Strong dividend growth, decades of increasing dividends. Recession-resistant, healthcare stocks often perform well in economic downturns. Global expansion, market reach across the world ensures continued growth. McDonald's, MCD, fast food, fast profits. McDonald's may be synonymous with fast food, but for long-term investors, it has been synonymous with fast-growing dividends. Investing in McDonald's in the 1970s and holding on to the stock while reinvesting dividends would have resulted in exponential wealth growth. Why McDonald's was a strong dividend stock. Franchise model, stable cash flows from franchise royalties. Consistent dividend growth, over 40-plus years of consecutive increases. Global expansion, strong international presence ensures revenue growth. Inflation hedge, pricing power allows McDonald's to pass costs on to consumers. A hypothetical $1,000 investment in McDonald's in the 1970s would be worth millions today with dividends reinvested. McDonald's continues to be a staple in dividend growth portfolios. Procter & Gamble, PG, everyday products, extraordinary returns. Procter & Gamble, PG, is another dividend king that has delivered exceptional returns over the decades. As a leading consumer goods company, PG sells essential products that people use every day, ensuring consistent revenue. If you had invested $1,000 in PG in the 1950s, your investment would have grown to millions, thanks to stock splits, share appreciation, and steady dividend increases. Why Procter & Gamble stood the test of time. Essential products, consistent demand for household goods. Dividend longevity, over 65-plus years of dividend growth. Brand strength, Iconic brands drive consumer loyalty. Resilient business model, stability in all market conditions. The power of reinvesting dividends. One of the biggest lessons from these case studies is the impact of reinvesting dividends. By automatically reinvesting dividends into additional shares, investors benefit from compounding growth. More shares generate more dividends, which buy even more shares. Dollar cost averaging. Automatic reinvestment buys more shares during market dips. Exponential wealth creation. Over decades, the reinvestment effect becomes massive. Had you simply taken dividend payouts as cash instead of reinvesting, your total wealth would be significantly lower. The secret to wealth building is allowing time and compounding to work in your favor. Lessons for the future: how to build a time-tested portfolio today. While we can't go back in time to buy Coca-Cola in 1960 or McDonald's in 1975, we can apply these lessons to our portfolios today. Here are key principles for identifying dividend stocks that could create wealth in the future. 1. Look for dividend growth stocks. Instead of focusing solely on high-yield stocks, prioritize companies with a history of increasing dividends. The best dividend stocks are those that grow their payouts year after year. 2. Invest in strong, resilient businesses. Companies with strong brand recognition, pricing power, and essential products or services tend to perform well over the long term. Focus on businesses that can withstand economic downturns. 3. Reinvest your dividends. To maximize long-term returns, enroll in a dividend reinvestment plan, DRIP, to automatically buy more shares with each dividend payment. 4. Hold for the long term. The biggest gains from dividend stocks come decades down the road. If you're constantly buying and selling, you won't capture the full power of compounding. 5. Diversify your holdings. Don't put all your money into one stock. Instead, build a diversified portfolio across different sectors, including consumer goods, healthcare, technology, and financials. Conclusion: while we can't time travel to invest in past dividend giants, we can learn from history to shape a winning strategy for the future. The key takeaways for investors are: dividend growth stocks outperform over time. Reinvesting dividends leads to exponential gains. Long-term holding is essential for compounding. Investing in strong, resilient companies pays off. By applying these principles today, you can build a portfolio that stands the test of time and creates lasting wealth, just like those legendary dividend stocks of the past.